Well, all right. Happy Tuesday, everybody. Your man Omid with you once again for a weekly market update. Coming to you a day late from President's Day yesterday, but we are back at it here. You'll find me today in my home office as we're taking off in a little bit to go to the Tri-Cities to visit some of our branches out there. So, with that aside, let's talk credit cards, shall we? Disturbing new release from the Federal Reserve of New York through Yahoo Finance. Ouch is right. We're seeing credit card balances rose $44 billion to a record high of $1.28 trillion by the end of 2025. Now, here's what's significant about this for us. As you can see, the credit card balances were very, very high towards the end of the great crash there in 2008, 2009. They sort of sorted themselves out and they fixed themselves, and naturally they went back up as people were locked out because of the COVID and not earning money, etc. But now look what's happened. It has absolutely spiked since 2021. And this is disconcerting to say the least. Now, a lot of what's happening is, unfortunately, people are spending on credit cards in order to be able to keep up with the Joneses. They're also seeing their 401ks and their investments in Wall Street go up. So they're becoming rich on paper and they're spending accordingly. However, as you can see there, percentage of credit card balances at 90 days plus late, they're not paying their bills. So if you or anyone you know is trapped in something like this, and if you're a homeowner and you bought a house in the last few years, chances are you probably have a good chunk of equity. And you definitely want to consider connecting with somebody who knows what these things work like myself, to be able to talk about tapping into your home equity to drag cash out in order to be able to extinguish those debts. The average debt on this list, you guys, is 26.5% interest. That is nuts, and it will never get paid down, versus the average debt on a HELOC is somewhere probably closer to 7.25%, 7.5%, depending on your credit. So this is something definitely worth looking into, okay? What's going on in the market for this week? Well, bonds are trading in this really kind of funky space. They're right here. If they can break through this 100.5 level that's established, it's actually 100.38. As you can see, test, no break, test, no break, test, no break, and now here we are again. If we break through this, better days are ahead. Right now, unfortunately, we're seeing 11 basis points down. On Wednesday, I want you to keep your eyes open for the Fed minutes. This is the conversation that they had last week. This is the minutes of those conversations. Durable goods is anything that's designed to last for longer than 3 trains, planes, automobiles, dishwashers, things like that. Seeing what those orders are going to be like. Initial jobless claims, once again on Thursday, and then the PCE, the personal consumption expenditure, comes out. My guess is going to be around 2.9%. That is the Fed's favorite measure of the inflation. Now, all the stuff that happened last week, if you followed us on Instagram, you would have been in the know. So definitely, if you don't follow us, give us a follow at Omid S. We post daily rates and daily market updates in your stories. So 30, 60 seconds, bang, zoom, you become the expert, okay? As we jump in, seeing about rates today, national average is at 6.04%, down from 6.15. That's a good significant movement from the movements that we had last week. And jumbos are sitting at 6.27 versus 6.33. Now remember, these are national averages based for purchase loans, not refinances, with 25% down on a shiny 780 or better credit score. You want to find out what your rates are and what your options are, definitely reach out to us. Other than that, have a fantastic short week. As always, subscribe, like, comment, and share so others can be as smart as you are. Thanks for watching with me today, and we'll chat with you again soon. Bye-bye.